to ease and by economic statistics that will make it overwhelmingly clear, and that's a word that Larry Summers used today. He advised the Fed not to change policy, not to cut interest rates until there was overwhelming evidence that the economy is weakening and inflation was coming below the 2% territory. We think there will be overwhelming evidence, and that will happen next year.
Cathie Wood's Bitcoin passion grows. The creator, CEO, and asset manager of ARK Invest is recognized for citing ARK Invest staff research. ARK and Cathie fund 5 new platforms: energy storage, blockchain, AI, multi-omic sequencing, since they evolved with 21 shares. The famous hedge fund manager considers these 5 top disruptive innovation platforms. ARK Invest, a fintech business, wants SEC clearance for spot Bitcoin and Ether ETFs. Wood applauds the SEC's Bitcoin ETF decision. At the January 10th deadline, the SEC's mood shifts. The famed hedge fund manager believes the cryptocurrency business will acquire a Bitcoin ETF and numerous licenses at once to ensure SEC applicant fairness. ARK Invest released Cathie's latest monthly no-video fiscal and monetary policy broadcast. Bitcoin and Bitcoin ETF market signals, economic facts, and innovation news are covered in the video. Cathie says Bitcoin was won before 2022. The highest asset of the decade from 2011 to 2021 was Bitcoin, returning 230% yearly. 10x the NASDAQ 100, the second best asset class of the decade in turbulent 2022. Bitcoin may be the best performing asset of the decade. Cathie discusses how all asset classes are following Bitcoin and her New Year predictions in the video. Comment and enable notifications. Enjoy the video.
Policy. This is, again, the federal budget deficit as a percent of GDP. It is very high by historical standards, meaning the deficit, the more negative, the higher the deficit. And we now have a new Speaker of the House who has to navigate a very difficult situation between Democrats and Republicans. But one thing I believe will not happen, and that is big spending programs, even though we're going into an election year. Very often in an election year, spending programs pop up all over the place because it's an election year. And representatives, senators, others want to give their constituencies good news. I don't think that's going to happen this time. And I think, in fact, we'll probably see surprising spending restraint. So I think if we're right, what will happen is spending restraint, but the economy softens. So it'll probably stay in this range for a while until we enter a recovery.
As Cathie indicated, ARK Invest is undertaking more study and work on Bitcoin in anticipation of an SEC-approved spot Bitcoin ETF. At this point, practically everyone agrees that a spot Bitcoin ETF will benefit Bitcoin and the digital assets industry. One of her latest Yahoo Finance interviews, Cathie said the chances of the SEC approving multiple ETF applications have increased significantly in recent weeks because the Commission has been actively communicating with firms about their applications and stipulating the minor changes needed to make this huge event a reality. The Commission has also hired several experts who are knowledgeable about Bitcoin and how it revolutionizes the financial system.
So let's move on then to monetary policy. So money supply started falling in July of 22 on a sequential basis. Since then, it has dropped 5%. Now, on a year-over-year basis, it's down roughly 3.5%. And you can see maybe it's ticking up a little bit, but that's only because we're now comparing against declines a year ago. So the so-called comparisons are getting easier. So very weak monetary supply statistics, and we're seeing the monetary base has dropped from, I think it was $8.5 trillion at the peak, to now about $7.7 trillion. So real shrinkage out there. Now, I've talked about velocity before. What has offset this decline and kept GDP growth moving up in the last year? It is this chart, velocity. The velocity of money has been moving up, and it's a cyclical move. So you can see the velocity of money, as measured by M2, peaked in 1997 and has been in a downtrend ever since. You can see during recession, so 2000 to 2002, velocity drops at an accelerated rate. You saw that again in 08, 09, and you really saw it during COVID. And what's happening now is we're just moving back to trend. And I think trend is at about 1.4, so we have a little bit more to go. But if we do enter a recession, and as you know, we think we've been in a rolling recession for roughly 2 years now, starting with back-to-back declines in real GDP in the first half of 2022. And of course, we've seen housing measures drop by up to 40%. Autos are in recessionary territory. We're seeing non-residential construction, especially in the office space area, in desperate straits, offset somewhat by IRA spending, the Inflation Reduction Act spending, which is focused more on infrastructure. But nonetheless, rolling recessions, and we think the next sector to pull back probably is the consumer. We're already hearing from retailers that the discounting is picking up in order to attract consumers into good deals. And we're hearing words like deflation used by a company like Walmart, very interestingly. So we'll get back to trend. And then, of course, the risk in a consumer downturn is that this velocity measure continues down, that it resumes its downtrend. And what would that mean? It would mean we'd have money negative on a year-over-year basis, and we'll have velocity starting to roll over. So that's how you get a really hard landing, unless the Fed pivots and money supply picks up dramatically. So in an election year, now the Fed is independent, but the Fed tends to stay out of politics and not make moves to favor one party or the other. But we do think it's going to be forced to ease by economic statistics that will make it overwhelmingly clear. And that's a word that Larry Summers used today. He advised the Fed not to change policy, not to cut interest rates until there was overwhelming evidence that the economy is weakening and inflation was coming below the 2% territory. We think there will be overwhelming evidence, and that will happen next year. So now let's go into, one other metric that I wanted to share. We did this last month as well, but I forgot to mention something. So this is the yield curve. It's the difference between the 10-year Treasury yield and the 2-year Treasury yield. And during recessions, and the recessions are in the shaded areas there, the yield curve either goes negative right before the recession or in the middle. You can see for the most part, it is a leading indicator. In the 80s, it was late 80s as well, into the 1990 recession. It inverted again. Inverted means went back below zero before the 2000 tech and telecom bust. Same thing with 08, 09, and here we are again. You can see the yield curve is inverted by more than in any other recession except the 80s. Now, the other thing that I wanted to mention here is you see where the yield curve goes during a recession when the Fed is stimulating and fiscal policy is also stimulating. It usually goes to the 2 to 3% range. What does that mean? It usually means 10-year Treasury yields are 2 to 3 percentage points higher than the 2-year Treasury yield. And you'll notice that during COVID, that did not happen. Interesting. And it is surprising because the world threw all kinds of monetary and fiscal policy stimulus at the COVID problem. And one would have thought that we would at least get back to the 2 to 3 percentage point area. We did not. Now, why? If we are correct, the reason is because the bond market is sniffing out a deflationary world out there. And so yields, long-term yields, just didn't go as high as many people expected them to go, and relative to 2-year Treasury yields. And it's because they're looking at these undercurrents of deflation. Lower inflation or deflation would keep long-term Treasury yields down. And we were looking at this in the day, and I was saying, wow, I didn't appreciate that all that stimulus couldn't get this yield curve back into the usual 2 to 3% range.
The SEC first delayed its decision on ARK Invest spot Bitcoin exchange traded fund application on August 11th, then 8 weeks later on September 26th, it said it would designate a longer period on whether to approve or disapprove of a proposed rule change that would allow ARK 21 share spot Bitcoin ETF to operate. The commission gave itself 60 more days to consider ARK's application, with a final deadline of January 10th, 2024. What do you think of Cathie Wood's interview and her Bitcoin predictions? Leave your comments below, like this video, subscribe to the channel, and switch on post notifications for more videos. Thanks for watching.